Good evening, everyone. Thank you for joining our Financial Wellbeing for Women webinar. My name is Bronwyn Horton, and I'm one of the financial planners here at Killick & Co. Tonight with me is Sarah Hollowell, Tax and Trustee Services Director, Svenja Keller, Partner, Head of Wealth Planning, Georgie Killick, Partner, Head of Innovation, and Rachel Winter, Associate Investment Director. This evening is the first in a series of webinars focusing on financial wellbeing for women. One of the main reasons for the series is that there is a plethora of evidence to suggest that men are more likely to invest than women, and that it is tended to be for women, they take more of a cautious approach to savings rather than investments. A report released at International Women's Day this year shows research to suggest that women are now likely to retire with a pension pot which is £100,000 less than men. Tonight, we'd like to share some of our experiences on how to get started with your financial wellbeing. This evening, I'll pose a number of questions to our panel. Some of these questions have already been submitted by you and built into our discussion. We'll also have about 10 to 15 minutes at the end for questions, so please submit these through the Q&A button. If you're not sure where this is, it should be at the bottom of your Zoom. We'll aim to finish about 5:45, but we might go slightly over depending on the questions. Now, before I jump straight into my first question, we'd like to begin with a poll. There are a number of reasons for us not to get started with our finances, but we'd like to know what's been the greatest prevention of you starting or reviewing your finances. So please choose the one of these questions that really shows why you haven't looked at your finances. So it might be that you don't know where to begin. You might not think that you've got enough money. It could be confidence. But there might be another reason for it altogether as well. So I'm just going to keep this poll open for a couple more minutes and wait for everyone to vote there as well. So please choose the statement that sort of really does sing to you about how you approach your finances. I'll just give it one more minute. We've got lots and lots of answers coming in. So please do vote. We do still have a few people joining as well at the moment, so let's give it one more minute. Do make sure you do vote. And I'm going to close the poll now. So there we are. Our sort of top result there is, I really don't know where to begin, which is why we're all here tonight. So what we'd like to do is break down some of these barriers for you. And Svenja, if I could start with you with our discussion. If someone is wanting to get started with reviewing and looking at their finances, where should they start? And maybe you could provide a little bit of an overview of our industry as well.
Thank you, Bronwyn. I think it's a really good question, and many people don't even want to ask that question, but I think it's really important to set out at the start. And the starting point for me is really know what you're looking for, because if you start entering our industry just looking, I think you might get swept up in all the different acronyms and descriptions, and it's really easy to get lost. The industry has grown, and as many industries, there are lots of different quirks and terms that aren't that easily understandable. So to start with, there are different options. You could go on your own. There's a lot of information out there. The problem is what can you rely on the internet, and it can in some cases get quite complicated. The second option is maybe a robo-advisor. So, and I'm sure Georgie will talk a little bit more about that, what the options are there. Or you go to a professional advisor, and there are lots of different options there. You could go to an IFA. They probably an independent financial advisor, that's the abbreviation for it. So you could go to them and get some financial planning and investment advice. And then you would ask, how do they do the investments in the background, for example. You could go to an IFA business that's linked to an accountancy firm or a solicitor firm, but they operate in a similar way. Or you could go to a private bank or wealth manager. And those institutions normally split the roles of financial planner and investment advisor. They're two different disciplines that really overlap. So you kind of need both of them, but they are very different specialisms. And Rachel and I work together on a lot of clients. And it's important for us to work together to optimize it for the client. So my job in a client relationship as a planner would be to build an overall strategy to answer the important questions, such as when can I retire? Can I afford to start my own business? Can I take a sabbatical? And build a real plan and a strategy. And then we go into the detail. So then what's tax efficient, in which tax efficient structures should the investments or the savings go? And then Rachel comes in and she will then invest the money once it's within the different wrappers. So lots to think about, but also lots to think about when you get started, what do you actually need? You know, do you need a plan to start with, or do you just want to do some investments? Do you want both? You know, do you maybe just want to start off with some information? So I think it's kind of getting into it and understanding the industry will help with that.
That's great. And now you mentioned the different sort of types of advisors. But how do you sort of find the right advisor or wealth manager? Do you have any sort of tips there on what people should look out for?
Yeah, I think that's another really important part of the process. And for me, there are three elements. The first one is more the housekeeping one. I say make sure they are registered with the regulator. You can look that up on the FCA website and the register. So make sure you go for a regulated advisor. But that's kind of the basics. But then there are two things. And I always split everything that I think about into people and processes. So on the process side, make sure the company is big enough to have enough research and technical capability behind them. So it's not our industry is very complex and fast changing. So make sure there are processes in place. They have the manpower and the capability to research and have adapt to changes. But equally important is find someone you're comfortable with. The people side is so important. Going through a planning and financial planning process is quite personal. You know, it requires you to talk about your goals and your ambitions, your family, what you want to do with your life, and seeing if your money can help you to achieve that. So for that, you really need to find someone you can trust. And I personally think that women sometimes struggle with that. I personally have sat in meetings with my husband where our advisor would just look at him automatically, and you think, I'm here as well. So you want to find someone who will take you, your family, your wishes into account and really understand and show some emotional intelligence. And for that, I would shop around. I would meet a few advisors and really see who you click with and whether you whether you trust them might be difficult, but, do you feel they listen to you and they really take into account what you have to say?
Excellent. And just quickly before we finish with you, Svenja, is there anything that people should think about before sort of seeing a financial planner? Is there any sort of preparation that they should do?
Yeah, it depends a little bit on the advisor. I would ask the advisor whether they want you to bring something. It can be really helpful to have like the normal things ready. What's roughly the value of your investments that you have to date? What's your income? How much do you spend? But if you don't know these things, don't worry. Your advisor will help you if you're not sure. I think the most important thing to come with is an open mind, and to be really open to talk about your ambitions and your dreams, and not think you need to hold that back. I think the more open you are with your advisor, the more they can do for you.
Brilliant. Well, thank you for your insights, Svenja. And Svenja, actually, you touched on the differences between a financial planner and what an investment manager does. So maybe, Rachel, you could expand on that, and maybe just give us a little bit of an overview of maybe some of the different types of investments there are out there, because we've sort of had these terms of bonds and funds and shares. It would be quite good to hear from you.
Yeah, of course. So an investment manager or an investment advisor is someone who will help you to put together a portfolio of investments that's right for you. And that part about it being right for you is really important, because not everyone has the same objectives and not everyone wants to take the same level of risk. So investments that are right for one person might not be right for someone else. And I often find that when I tell people what I do, they'll say to me, what's a great stock to buy right now? And that's an impossible question, really, because it really depends on what that person is looking for. And for example, say that you're 25 years old and you're investing money in your pension, you won't be able to access that money for another 30 years. And that means you can probably afford to take quite a lot of risk, because if the market falls, you've got plenty of time ahead of you to wait for that market to come back. Whereas if you're retired and you're depending on your portfolio for income, then possibly you might want something a bit more stable. So it's really important to make sure that you're taking the right amount of risk. And often we find that people worry about taking too much risk, but it's also important to worry about taking enough, because Bronwyn, at the start of this presentation, you talked about how women have historically held quite a lot of money in cash, and that doesn't offer a great amount of return over longer time periods. And holding too much money in cash is one reason why women today do tend to have lesser amounts in their pension. So it is important to make sure that you're taking enough risk as well. And the way that we manage risk is to look at the different types of things that we're investing in and the different mix of those that we've got within our portfolios. And there are lots of different things that we can invest in. And to use the lingo or the jargon, we tend to call these asset classes. So the biggest asset class would be equities or shares. So if you buy a share, you are becoming a part owner in a business. And if that business does well, it becomes more valuable and hopefully your share will go up. Unfortunately, the same is true on the other side. If the company doesn't do well, then it will shrink and your share price will probably go down. But over the long term, we tend to find that equities or shares offer the best rates of return. So they are quite risky, they can be quite volatile, but for those people who are willing to take on a high level of risk, they would probably have quite a high proportion of equities in their portfolio. And then at the other end of the risk scale, we've got bonds. So buying a bond is a way of lending money to a company or to a government in return for a fixed rate of interest. And because that interest is fixed and it's limited, we tend to say that bonds are much less risky than shares. So for that reason, if you are quite cautious, you'd probably have a higher proportion of bonds in your account. And then finally, we've got funds. And so a fund is essentially a pool of money that's managed by an external fund manager. The pool of money will be spread across lots of different investments. So if you put your money into the pool, your own money will be spread across lots of different investments. And a fund might focus on shares, it might focus on bonds, it might focus on property, it might focus on a mixture of all of those things. There are so many different funds out there, and there will be a fund that's right for everyone. And one of the negatives to consider with funds is that they do have an internal charge because you have got someone managing that fund for you. But one of the good things about them is that you can just buy into one fund, and just by buying into that one single fund, your money will be spread across lots of different investments. And that means that you're spreading your risk and you are quite well diversified. So funds can be a great starting point for anyone who's new to investing.
Great, thank you, Rachel. That's a really good overview. One question that we often get, and it came through on our questions earlier, was how much does somebody need to start investing?
A good question, actually, because I think a lot of people assume that you can't invest unless you've got millions of pounds to start with, and that's absolutely not the case. There are different services that can be good for different levels of investment. So let me first talk about the different types of investment services that are available. So the most basic one is something called execution only. And that's really where you just need a platform to execute your orders for you, and you know already exactly what you want to buy, and you don't really need any help. So that type of service is quite basic. It can just be done online. And with those types of accounts, you could probably start with as little as about £100. You then got a service called advisory investment management, and that's where you'd work with an investment manager. You would talk to them about your objectives and what you're hoping to achieve, and that person would work with you to recommend specific investments. And so here at Killick & Co, we do have an advisory investment service. We don't specify a minimum for that, but I would say that between £2,000 and £5,000 would be a good starting point for that type of service. And then the final one is discretionary investment management. And that's where you would hand your money over to an investment professional or possibly to an investment platform, and they would manage that money for you on an ongoing basis. Now, if you wanted that money to be managed by a person and you wanted it to be invested in individual shares, then that's possibly where the slightly higher starting points would start to come in. So I would say for that sort of service, you'd be looking at a starting point of perhaps £100,000. But these days, we do also have lots of discretionary apps or robo apps, which can manage much smaller amounts on an ongoing basis. And there are some that can manage money from £25 per month and upwards. And I believe that Georgie will be talking to you about that later, because that's really her area of expertise.
Excellent. Well, thank you, Rachel. And actually, speaking of Georgie, that's a great segue into your area. Could you explain what sort of robo apps are, what are they, and who are they right for as well?
Yeah, of course. I mean, I guess you can kind of describe robo apps as the newest kid on the block in terms of wealth management solutions. And in a nutshell, they are a digital platform that uses algorithms or information that you give it to invest into a portfolio of funds for you. And these apps are great for anybody who is sort of just wanting to get started on the investing journey. They may not have a large lump sum, or they may not yet have the confidence to want to have a conversation with somebody, but they still want a smart, intuitive, easy way to start investing. And I can kind of give you a real world example of how exactly they would work. You know, here at Killick & Co, we launched our Save and Invest app, Silo. And the way it would work is you would go to the App Store, or you would go to Google Play, depending on your device. You would download the app, and then you would start giving it some information about yourself. So rather than actually having a conversation with an advisor, you start giving the information to the app. And there would be sort of, you would talk about, you know, your financial circumstances, whether you have any dependents who are reliant upon you, and how you would deal with your finances in certain scenarios. And then based upon that information, it would determine the most suitable plan for you. With Silo, you would then be invested into a mixture of different funds, and it would be anywhere up to about 15 different funds, all of which would be curated and managed for you by our Killick & Co team. And the great thing with the robo apps and things is you don't have to choose which fund. So if you don't have a lot of experience or knowledge, you know, it will basically choose where your money should be invested and how it should be invested based upon, you know, the questions that you get asked. You then have the ability to choose how much you want to save and whether you want to be putting a lump sum in, whether you want to regularly save. And, you know, and like was mentioned earlier, you know, they do have very small minimums. Silo, for example, is sort of £25 a month, but majority of all the sort of robos do have quite low minimums. I think one point to remember, if you are wanting to go down the robo route as your first kind of investment journey, is there's a couple of stages that you need to think about in your own mind and make sure you feel comfortable with. Is, One is, do you have any bad debt? And what we mean by that is any kind of payday loans, anything with high interest rates, not sort of mortgages or anything. If you do, pay that off first, go away, get rid of that. And then also after that, ask yourself, do you have cash rainy day fund? For the emergency, for the boiler that's broken, or for the circumstances that we can find ourselves in. I think COVID is a kind of a prime example of that. But you want to know that you have some cash that is easily accessible. You don't want to be a forced seller with your investments, and you also don't want to be using your investment portfolio like a bank account, dipping in and out of it. And I think that leads nicely onto the kind of the third point when you're thinking about investing, is that you need to think about investing as a long-term thing. It's not I want to save up for the holiday this summer, and so I'm going to start investing, or I'm wanting to buy a house at the end of this year. You must be thinking a minimum of kind of 5 years when you're planning to invest.
Brilliant, Georgie. And what about how much sort of financial knowledge does somebody need to use the digital savings apps? And I guess, and how safe are they as well? What should we be looking out for?
So I think on the sort of safety side of things, it goes to the point that Svenja made earlier as well, is checking that they're FCA registered is the first sort of point of call. And then starting to sort of answer your question on, what level of experience. The reality is none. They are the perfect place for somebody who is wanting to start their saving and investing journeys. You've got to think most of these robos have actually been designed and built for people who have little to no experience. Now, that's not to say that, they're not suitable if you've got lots of experience. They can still be a really good tool, but they have predominantly come about to help people who have felt that they didn't have access to investing solutions, and have completely democratized the world of investing. So no, you don't need experience at all to start using them. And they're also particularly good for anybody who might be slightly nervous about investing, because you can start with these really small amounts and it's in the palm of your hand. You can access it 24/7, and you can slowly just sort of build up your confidence. The best way to learn about something is really starting to do it. But if you know that you can kind of start at a really small amount and just slowly build your confidence, I think that's a really sort of, that's great. And then just, previously I sort of mentioned about starting your saving and investing journey and the sort of stages that you need to go through, ensuring that you've paid off any payday loans or anything like that, having a cash fund, and thinking about investing for a long term. But I think there's also an important point of, thinking about that what happens when moment. Now, it might be that you've just started your saving and investing journey, and so using a robo tool is completely all you need right now and exactly perfect for you. But I think it's also important to note, as your financial life may become more complicated later on, it's really worthwhile to know that you can speak to an advisor and start thinking and building out a kind of a financial plan. And when we talk about this, what happens when moment, it is completely unique for anybody and everybody. It might be that you have a growing family, or you come into a large inheritance, or you've just sort of been saving this pot that has grown quite nicely over time. And so you now just want to check, am I doing what I should be doing? Should I be thinking about something else? So by taking that sort of next step and talking to an advisor to start thinking about creating a plan is really important.
That's brilliant. Thank you so much, Georgie. I think you've really highlighted the different areas that we need to think about. So I guess once we've started building up some investments, Sarah, I guess this is, when do we need to be aware of the family's financial situation, and what about single people? How do we sort of handle these sort of sides once we've actually started to build up our assets?
Okay, thanks, Bronwyn. I think that the first thing you need to do, whether you're single, married, in a relationship, you should always give consideration to what might happen to your assets if you're unable to look after them or if you die. I don't just mean putting lasting powers of attorney and wills in place. Obviously, they are excellent solutions, and we'll be touching on that in much more detail in another webinar. But you need to be talking about them as well. Just having them there isn't enough. Anybody can lose the ability to look after their affairs at any point. I don't necessarily just mean long term. Someone might have an accident at work, or they might be on holiday, and so that they could lose the ability to look after things maybe just temporarily. And the person who you've appointed to look after your affairs, they might well be feeling quite stressed and upset because of the situation they're in. And things are much, much worse for them if they've got no idea of what they're actually facing. And that same concept applies to wills. Very frequently, people might appoint a family member, very often a spouse, to act as executor in their estate. And then when they pass away at the very worst possible time in their life, they're left with all of this administration to deal with. And sometimes they've just got no idea of what the assets might be. There was a really popular TV drama on not so long ago, actually, and I think that it caught the eye of quite a lot of people. There was a lady who suddenly lost her husband at a very young age. She's got a young family, and she had no idea about the family finances, about her partner's business interests, and all of their money was tied up in a joint account. So that was frozen when he died. She'd got no access to money at the worst possible time, and then she had to try and untangle things. So I think that was a really good example of the problems that people have if they don't speak to each other. And I think that one of the reasons this comes about is because people get embarrassed about broaching the subject. So you really need to speak to your parents and speak to your children about what your assets are, who your service providers are, and so on. And then alongside that, have a good list of everybody who banks, your telephone provider, everything, and all of their contact details, and keep that information in a safe place or with a trusted person, perhaps with your will or something. And I think that perhaps this is even more important now because most of us have got some sort of digital asset, and we wouldn't want those to be lost in the event that something happened to them. And it's not just online bank accounts, it might be photo files, music files, cryptocurrency, it could be absolutely anything really. So you need to make sure that there's details of those assets and how to access them as well. And it's just as important for single people. It's not just talking to your family. If you're single and you don't have a family, then you should have a trusted friend, or if there's nobody who you'd like to burden with that, then speak to a professional, because they can keep that information for you along with your will, and they can also act as your attorney or as your executor.
Brilliant, thank you, Sarah. And what about HMRC? When does somebody really need to start interacting with them, apart from our regular tax returns?
Okay, I think that there's a common misconception really that the rules of self-assessment only apply to people who are already in the self-assessment regime. So a lot of people don't have an obligation to complete a tax return, perhaps because their income is all covered by various different allowances, or it's all been taxed at source. But you might have a lump sum payment, perhaps a lump sum pension payment, a divorce settlement, inheritance. It could be anything really. And once you've received that lump sum, it might start working for you. So you could start to receive interest or dividends. Now they might put you into a different tax bracket, or they might be gross investments that mean that you've then got an obligation to tell HMRC, well, it's your obligation to let them know. So if you do have a change of circumstances, you have to let HMRC know by the 5th of October following the year that you had this income. And the same applies to capital gains as well. If you make disposals with significant proceeds, even if there's no gain, you should tell HMRC, who will then send you a tax return. And a new one as well is if you sell a property, a residential property that isn't your main home, you've actually only got 30 days to submit a tax return to HMRC, a CGT on property return, and pay the associated tax. So instead of having potentially a year and a half to pay that tax, you've only got a month, and that can often take people by surprise.
Oh, brilliant. Well, thank you, Sarah. Now, just before we jump into the Q&A section, I'd just like to quickly hear from each of you as to what's your top piece of advice for people who want to get started with their financial well-being. Maybe Svenja, if I can throw it over to you first.
Yeah, thank you, Bronwyn. My top tip would be not to be put off by the word wealth. A lot of our industry uses the word, and it gives the impression that only very wealthy individuals should come to us. but actually, as we've demonstrated with various other answers, there are different ways of accessing investment advice and financial planning advice, and it's important to think that we can provide something for most people.
Excellent. And Rachel, what's your sort of top piece of advice?
Mine would be the fact that I often talk to people about investing and they always say, I assume it's really complicated and mainly really boring. I would say to people, don't assume that's always the case, because it can be quite simple and it can be absolutely fascinating. So it doesn't always have to involve loads of number crunching. It can simply be a case of picking out trends that are happening across the world. And these could be trends like an increase in renewable power, an increase in online payments. And these are all trends that we all see happening around us. So they can be really interesting and they can be quite simple to understand as well.
Brilliant. Thank you, Rachel. And Georgie?
Mine is always to just start. I think too many of us kind of put our head in the sand when it comes to managing our finances, and also probably, you know, to Rachel's point earlier, find too much comfort in cash and be, you know, afraid of investing. You know, don't be afraid of investing. And so I say, give yourself a deadline. Maybe it's the end of this weekend, but by the end of the weekend, you're done your research, know where you want to go, and either on Monday you're picking up the phone to speak to an advisor, or you're downloading an app and starting investing.
Brilliant. Thank you, Georgie. And Sarah?
I think don't be afraid to ask questions, because although you can go out and get so much information from what's out there on the internet and from the financial press and so on, everybody's question that's specific to their needs. So ask those questions and don't be frightened that it's going to be a silly question, because no question is a silly question. And for you, if it's really important, then you should get that answer.
Brilliant. Thank you. And so I think it's now the time to jump into our Q&A section. So if you haven't already, please do submit some questions for us. We'll try and work through them as quickly as possible. And yeah, don't be shy, please do ask. One of the questions which has come through is one of our guests is saying that she's 77. Is this too late to begin? Does somebody want to sort of touch on that?
I'm happy to. So I would say it's never too late. It's just a case of working out exactly what your objective is and making sure that your investment portfolio fits with that objective. So your objective might simply be that you're not happy holding cash and you want a bit more income. Your objective might even be that you want to leave money to the next generation. And if that's the case, then perhaps the sort of risk profile of your portfolio might not suit your needs, but it might suit the needs of the next generation. So as long as the risk is right, then I don't think it's ever too late to start.
Excellent. And one question that's come in probably for Georgie to answer is, what sort of the level of fees that are involved with robo tools and robo apps? Could you take us through what?
Yeah, I can. Yeah, definitely can. I mean, I think that they are all slightly different. If you're looking at the sort of the all-in, they're probably around the kind of the 1% mark would be the sort of, you know, the average that you'd be looking at. But they can be broken down in different ways. So what I can give you is the example of how we do it with Silo. There is the kind of the Killick & Co management fee, which is £1 a month until you have £2,000 invested, and then it converts to 0.75% of your investments. But there is also the a second fee, which we kind of call our fee B, which is the fund manager's fee. So those are the funds that you are invested in. They have their own set of fees, and they go anywhere between sort of 0.25% really.
Excellent. No, that's great. Thank you. One interesting one that I think Svenja might be able to answer for us is, what one thing do you wish women close to you or in your life not only knew, but wish they were sort of actively doing in relation to their finances?
Yeah, I saw the question and I really love that question. Immediately, I thought from some of the kind of couples that I look after as clients, my advice would be not to just take a back seat and let your partner deal with everything. I think take an active interest, ask all the questions in the meeting, and a good advisor will incorporate both your views and both your levels of understanding. And I think you know, as Sarah said earlier, there might be situations where all of a sudden you are taking over, maybe your partner is ill or even worse, passes away, then you need to be able to take over. But also, make sure your wishes are in the plan and you feel you're in control. So I think that's really important.
Yeah, that's brilliant. Thank you. And one for Rachel. Maybe could you talk us through some of the pros and cons of advised versus the managed service?
It's really about how you would like the account to be run. So with the advisory services, you are in complete control, and the investment manager cannot place an order without a specific instruction from you. So if you want to be involved, if you want to be consulted about every trade on the account, if you want to learn about investing, then advisory could be a great option for you. But it does take more time because you do have to be involved. So if you're busy, if you're just not interested, then that's when perhaps a managed service might be more suitable for you.
Great. And possibly, I'm just having a quick look here. Georgie, another quick one about Silo. Can it be set up for a minor child in their own name?
Yes, absolutely. You can set up a junior ISA and so start saving into, your child's junior ISA, which they will then have access once they turn 18.
Okay, great. And let me have a look here. Just going through. So I'll throw this one open to any of you who wants to sort of define this. What's the difference between a broker and a fiduciary? Spinny, do you want to have a go at that one, or?
Yeah, these are quite specific terms. I think we all looked a bit stumped because a broker is kind of a more traditional stockbroking approach, which actually is Killick & Co.'s heritage. So Killick & Co. started off as a stockbroking firm, and the broker would have been what Rachel is doing now. So to some extent, but Rachel covers other things as well. She would take orders and phone the client and say, would you like to invest in this stock, and then trade the stock. A fiduciary is really, it's not a very UK term, or not very big in our industry. I would say it's more of an overarching term for someone who takes care of finances, but it's not really a term we would use in the wealth management industry. Not in the UK, so apologies.
No, that's fine, that's great. And a couple coming through regarding sort of pensions. So we've got somebody here who's just about at the point of retiring and needing to consolidate a number of pensions and review her portfolio to see, whether she can draw an income. This obviously seems quite daunting to her, and it's a daunting task. Is this something that she needs to do on her own, or is this something that we can help with? What would be your?
I will take that one as well, because this is exactly what planners do. Pensions can be quite complex wrappers around investments. Some of them are simple, but some of the older plans have gone through a number of legislative changes and then benefited from some different rules. Plus, some of the older plans have some benefits attached to them that you might lose if you transfer. So you might get loyalty bonuses or guaranteed annuity rates. You might get bigger than 25% tax-free cash. It gets very technical very quickly. So and the other thing I would say is retiring and switching from a regular paycheck to living off your assets is one of the biggest financial transactions or phases you will go through. I would say, unless you're very confident, don't do it on your own, and do take advice in this instant. There are a lot of things to think through, and to the person asking the question, I would say some encouragement as well. I know it's daunting, but an advisor will deal with the detail. You almost don't have to get that involved in that. They will get all the information. But the exciting bit is, what will you do with your retirement? Have you thought about how you're going to spend this phase of your life, you know, what exciting things have you got planned, and can this be built into your financial plan? That's the exciting bit. So maybe don't think so much about the detail and the boring pension bits, and think more about what your next phase in life will be and how you can make it the best that you can.
That's great. Thank you, Svenja. And maybe one for Rachel. So one of our questions has come through that she has a managed fund which is separate to her husband's. How often should I be checking in with my investment manager? Yearly or every 5 years? When should sort of funds, managed funds be reviewed?
I would say at least once a year. You shouldn't need to change it that often, but it's good to check in at least once a year, just so you can get an idea of how it's performing. And if it is underperforming for any reason, then you've got time to take action and do something about that. And I do think the more often that you check it, just have a check of the valuation, it just helps you to understand it a bit more and just to feel a bit more comfortable. So I would check it at least once a quarter, and perhaps have a more formal conversation with your investment manager at least once a year.
Excellent. And maybe a couple for Georgie around, helping our children get started. We've got a couple here about helping an 18-year-old daughter to get started. And also too, what should we do about teaching, 13-year-olds as well about how to approach finances? So maybe if you could sort of touch on those two, because they are quite similar.
Quite similar, but I guess also slightly different. I mean, once a child turns 18, it is technically, let's say if we were going to talk about a sort of junior ISA, it is in the kind of, the parents are sort of the ones who kind of manage that and things, but it is technically owned by the child. So when they turn 18, they have access to that. If it is an 18-year-old, the best thing to do is really be kind of encouraging them and maybe helping them set up an ISA, and helping sort of, add a little bit of money into that. And I just do think that with all of these things, the more that they can be involved in it, the more likely they're going to really understand, the value of the money that they're building up, and they're not going to go and just sort of spend it as soon as they possibly can. So I think the more you can get children involved in understanding about their finances, definitely the better.
Excellent. Great. We've got some fantastic questions coming through. We might have an opportunity just to answer just a couple more as well. Let me just have a quick look down here. We've got a number of people asking for a few resources of where to go to for things like pensions and learning more about the industry. I'll cover that off for now and our wrap up, because we will send you out a few resources to get you started. But definitely, do have a good look at our website as well, because there are quite a few good resources there as well. But we will cover that off at the end. And maybe just a couple of silo questions for you, Georgie, as well. How long does it take to take money out of Silo and out of a robo app? And maybe, does it have the same level of financial protection or regulation as I think you touched on that when you spoke, but maybe if you could just reiterate that one as well.
Yeah, just on the regulation side, yes. So you want to be checking that, that they are sort of FCA regulated and FSCS protected, which robos should all, they should have. And then on the withdrawing side of things, this is your money, so people should be able to access it. So there are no withdrawal fees. People can, withdraw it as much as, and as often as they want. We encourage people to say, investing obviously is the long term, but this is your money to do what you want to do with it. It can, from a silo perspective, we trade right now just weekly. So it can take anywhere up to 2 weeks for the money to, to liquidate and then move into your bank account.
Excellent. And one more for Rachel. So obviously, firstly, what's the best way to sort of streamline ESG across investments? And also too, maybe if you could touch then on, how does sort of cryptocurrencies sort of fall into all of this as well?
So ESG stands for environmental, social and governance, and it's really a way to invest ethically. So you're looking for companies that don't harm the environment, that don't harm society, and that are well governed. So a lot of companies are now advertising ESG services or funds, But the issue at the moment is that there's not really a universal way of measuring a lot of these things. So it can become quite a personal thing. So what I would say is, if you are investing in an ESG service or an ESG fund, really have a look at the terms and conditions and get an idea of what they mean when they say ESG, and make sure it aligns with what you believe ESG should be. And one example I always give is a company like Royal Dutch Shell, one of the biggest oil companies in the world. Some people would say not ethical at all, it's clearly destroying the environment. Others would say it's really making good strides in renewable power and therefore it's moving in the right direction. Therefore, I think it's trying to be ethical. So it really is a judgment call, and it's very much a personal opinion. So you really need to look at the T's and C's and make sure it aligns with your values. Cryptocurrencies, I have to say, are causing quite a problem for us at the moment, because the regulator has basically said we're not allowed to advise on them or to buy them for clients. But I can say that mining for cryptocurrencies does take up a huge amount of power. And in an era where we're trying to use less power and reduce our carbon emissions, I would say that they're not particularly good for the environment.
Brilliant. Thank you, Rachel. Well, all of these questions have been fantastic, and unfortunately we've run out of time. Any unanswered questions, we'll follow up with the team in the next couple of weeks. If you have any further questions, please do email them in to events@killit.com, and we'll ensure that you receive an answer on those. But really, I'd like to thank you all for taking some time out of your busy days to discuss getting started. We hope that it sparked an interest for you all to think about your own financial well-being. To help you, as I mentioned earlier, with some of these areas that we've covered tonight, we'll send up a follow-up email tomorrow with a lot of useful material to get you started. Included in that email, we'll also have a survey as well, so please do give us feedback. It's really important to hear from you, so that we know that obviously you've enjoyed tonight, but also too just to give us some guidance as to what you want in the future. We're going to aim to run our next webinar in this series after summer. And we'll be focusing on estate planning, which Sarah sort of touched on, things such as wills and lasting powers of attorney, and how do we look after the costs of elderly relatives later on in life. And then also towards the end of the year, we'd like to run one of these on retirement planning. There's quite a few questions around pensions, so we'd like to sort of touch on that as well. So please do keep an eye on the inbox for an invitation for those later on in the year. But once again, thank you so much for being with us, and we hope you enjoy the rest of your evening. Thank you.